Okay, next is section 48, which gives you a very simple method of computation of capital gains. This is a very simple stuff. And how do we do it? We consider the sales consideration. Okay, and from that we reduce the cost of acquisition. Obviously, when we are considering the cost of acquisition, we will consider the indexed cost of acquisition. Indexation part we will discuss later on. Then we consider the cost of improvement. If any improvement has been done to the asset, any maintenance cost has been paid by the asset, which is a considerable cost adding to the life of the asset, then it is capitalized. You know that any cost of improvement, if incurred by the SSC towards the asset, again that is indexed. Indexation is done for that, for the inflation purpose. And then any expenses relating to the which are relatable to the asset, that is in connection with the transfer of the asset, if any expenses are incurred, that is to be considered. Okay, so this is the simple computation of capital gains. Now, for section 48, there are different provisos being given, where you will exactly not follow what is given over here in section 48, but slight deviations are there. Some of these provisions will apply to non-residents. Okay, like the first proviso to section 48. So normally as per section 48, it's the computation of capital gain is sale consideration, less cost of acquisition, less cost of improvement, less expenses on transfer of the asset. But then certain provisos come. Provisos are when you're deviating from what is written in section 48. Slight difference will be there in how you actually do the treatment. So first proviso to section 48, which says that capital gains in case of non-residents. If you're talking about the non-residents, then in that case, what is to be done? Only in case of non-residents, okay? And non-residents will include foreign company also. If there is a transfer of any share or debenture of an Indian company, okay? If there is a transfer of any share or debenture of an Indian company, then for them, the capital gains will be converted into the currency which was first used for making such investments. Which means if it's a US investor who is making purchase of the Indian shares or debentures and he qualifies as a non-resident, then for him the capital gain computation should be done in dollars. It's not about taxability. Taxability will be covered in some other section. But first proviso says that if it's a non-resident who is investing in the shares or debentures of an Indian company, and this guy is making investment by bringing dollars into India, then for him the computation of capital gains should also be done in dollar terms. I hope this is clear, right? So cost of acquisition, expenditure incurred wholly and exclusively in connection with such transfer, and sale considerations received or accruing as a result of transfer of capital asset shall be converted into the same foreign currency. Look at this language, same foreign currency as was initially utilized in the purchase of such shares or debentures. The capital gains so computed in the foreign currency shall be reconverted into the Indian currency. Once you do the computation of the capital gains in dollar terms, then again you can reconvert it into the Indian currency. The question is, sir, how will I know what rates are to be used for conversion? All that is given in the rules. There is a rule which explains you that sale proceeds should be converted at what rate, expenses on transfer should be converted at what rate, capital gains should be converted at what rate, and purchase consideration, that is the actual cost of acquisition, should be converted at what rate. So basically, I'll tell you right away, we use telegraphic transfer rates. Practically, telegraphic transfer rates refer to the retail market rates. When you buy or sell currency in the retail market, we have done that in Forex and SFM. When you buy or sell currency in the retail market, those rates average is to be taken in some places, and in case of computation of capital gain, we only consider the telegraphic transfer by rate. This is given in the rules. But before we get into the rules, let us now read the analysis of the first proviso. Are you clear about it? So normally computation should be done as per section 48, but first proviso says that in case of a non-resident who is making purchase of the shares or debentures of an Indian company, then for him the computation of capital gain should be done in the currency which he initially utilized for making purchase of such shares or debentures. Once you have done the computation of long-term or short-term capital gain, then it will be converted back into Indian rupee equivalent. Okay, so I told you first point, non-resident will include foreign company. We know that. For the applicability of the first proviso, the shares or debentures should be purchased in the foreign currency, or it should be a case of reinvestment. Okay, it should be purchased in the foreign currency. And next is debentures includes bonds. The shares, debentures, and bonds of a government company are also covered. But what is not covered in first proviso is the bonds issued by central government or the state government or the RBI. If these three are issuing the shares or debentures, then first proviso will not apply. Central government, state government, RBI. Next, even if it's units of business trust or units of UTI or units of mutual funds, then the first proviso will not apply, because first proviso makes it very clear that it is applicable only in case of shares and debentures. First proviso will not apply to units of UTI, mutual funds, or units of business trust. Let's be very, very clear on that. So basically, any shares or debentures issued by central government, state government, or RBI, first proviso will not apply. And if there are units of UTI, business trust, or it is units of mutual fund, then also the first proviso will not apply. The first proviso shall apply to listed as well as non-listed shares or debentures. Now, shares or debentures are covered, and whether it's listed or unlisted does not matter. SSE should be a non-resident when the transfer of the such shares or debentures are taking place, the year in which they are sold. Next is very, very important point number 8. Wherever first proviso will apply, the benefits of second proviso cannot be taken. What is second proviso to section 48? Second proviso talks about the indexation, that in case of cost of improvement and cost of acquisition, we should consider the indexation benefit. That is, the cost inflation index should be considered. But wherever for a non-resident the first proviso applies, in those cases second proviso benefit cannot be taken. I hope this is clear, right? So you can read it. Point number 8 you can read. Even 9 you can read. Okay. Point number 8 and 9, please read them. The same thing which I said. Next is point number 10. This proviso is applicable for computing short-term capital gain as well as long-term capital gains. And Finance Act 2018, if you remember, I told you so many times, Finance Act 2018 made one big major amendment, which was section 112A was introduced in place of section 10 subsection 38. So wherever 112A will apply, then 112A should be followed, and in those cases first proviso cannot apply. I hope this is fine with you, right? Now, I told you for the purpose of conversion from rupee to the foreign currency, and again back from foreign currency to rupee after the capital gains are calculated, that is given in rules, and rule number 115A basically talks about it. Rule number 115A gives you the method of conversion. Okay, so once you talk about the cost of acquisition, then cost of acquisition should be taken at the average of the TTBR and TTCR, average of telegraphic transfer buying rate and telegraphic transfer selling rate as on the date of acquisition of shares or debentures. This is very simple. For the shares purchased or debentures purchased, take the rate on the date of acquisition and take the average of TTBR and TTSR. TTBR, telegraphic transfer buying rate, TTSR, telegraphic transfer selling rate. Number 1. In connection with the transfer, we will take average of TTBR, TTSR on the date of sale, on the date of transfer. We will take the average of the TTBR and TTSR. For sales consideration, again, we will take the average of TTBR and TTSR, but capital gain should be taken by applying TTBR on the date of transfer of shares or debentures. So for sale, on the date of sale, for purchase, on the date of purchase, for expenses in connection with transfer, on the date of sale, average. Everywhere you are taking average of TTBR and TTSR, but once you've calculated the capital gains and converting back from capital gains into rupee equivalent, you will only consider TTBR. On which date? On the date of transfer. Okay. So just go through question number 2 and see if you're able to understand. Question number 2. Please go through it. There's nothing much I have to speak in this. Just go through it and I'll get back to you when I need to intervene. I'll tell you. Guys, I hope you understood this computation. The first part of the computation, I hope you have understood. For sales, we have taken the TTBR, TTSR average on the date of transfer. The same will be taken on for the purpose of expenditure. You see this? This one. And for the cost of acquisition, you have taken TTBR, TTSR as on that date. That is on the date of acquisition. Once you calculated the capital gains, then you multiply with 69 to convert back into rupee equivalent capital gains, right? Now, here it becomes a little interesting. See, you need to understand one thing. Section 48 only deals with the method of computation of capital gains. And even first proviso only tells you how computation should be done if we are fulfilling two conditions. It is a non-resident who is getting involved in purchase of shares or debentures of an Indian company. I hope this is clear to us, right? Now comes a very important point of discussion. The taxability of long-term capital gains is dealt with in section 112. So section 48 does not tell you how taxability of long-term or short-term capital gain should be done. That is covered in section 112 or some other sections like 112A or 111A. Only computation part is told by section 48 and the relevant first, second, third proviso, whatever it is, right? So if it's the listed equity shares, then sir, whatever capital gain you calculated, 10% of that will be taxable in case of non-resident. But if it is a unlisted equity share, then whatever computations you have done above will not be relevant. In that case, we will simply take the rupee sale proceeds, rupee transfer expenses and rupee cost. And based on that, whatever you get, 10% of that will be taken. I hope you understood what I am saying. 112 defines how taxability will happen under what circumstances. Section 48 only has the role of telling you the method of computation. So for computation purpose, you defined that your total capital gain should be 1,46,763 by applying TTBR, TTSR rates for conversion and then converting back the capital gain into rupee equivalent. But as far as taxability under section 112 is concerned, it defines that if it is a listed share, then you can please follow whatever you have done for the purpose of conversion under section 48. But if it's unlisted, then conversions will not be considered. And based on rupee cash flows only, capital gains will be computed and taxability will be done based on that only. Okay. So what you can do here is, this is important for you. You can just write a small note here. Section 48 tells us method of computing capital gains. Please write. Section 48 tells us method of computing capital gains. However, taxability is covered under section 112. Taxability is covered under section 112. Taxability is covered under section 112. I hope this is fine. Now, you reinvested this money and you purchased other listed securities which has been disposed of in less than 12 months, because of which it becomes a short-term capital gain. And once again, you can just go through it. That is, the average of TTBR, TTSR rates will be taken on the date of transfer for sale price and on the date of acquisition for purchase price. That is 30th of December and 24th of April. And once again, this capital gain will be converted back into rupee equivalent at the TTBR. No average for capital gains conversion back into rupee. No average is done. You will take only the TTBR. Short-term capital gains now will be taxable at the rate of 15%. The special rates will apply under section 111A, assuming that shares are sold on a stock exchange and STT has been paid. So basically, the transaction should have been done through a recognized stock exchange. And the moment you do transactions through recognized stock exchange, by default, your transactions will be subject to STT payment. Okay. If shares are unlisted, then normal tax rates shall apply. So that we will study when we are into section 111A, 112. Okay, I hope this part is clear. I told you second proviso to section 48, which talks about the indexation benefit. This proviso is not applicable where first proviso will apply. It will not apply where section 112A will apply. So there are two situations in which second proviso will not apply. Wherever first proviso will apply, that is in case of non-residents involved in purchase and sale of shares or debentures of an Indian company, then first proviso will apply, and in all those cases, second proviso benefits cannot be taken. You just saw the last two examples. We have not considered indexation benefit. Wherever section 112A will apply, over there, second proviso shall not apply. Okay, that is as per Finance Act 2018. Where the capital gain rises from the transfer of a long-term capital asset, obviously only in case of long-term capital asset, indexation benefits will be given, because short-term is within 12 months, and within 12 months, inflation benefits will not be given to you. Then for the purpose of computing capital gains, we should consider indexed cost of acquisition and indexed cost of improvement. So from the year 2001, with 2001 being taken as a 1/4/2001 being taken as a base year, and for the base year the value will always be 100, and for 1920, that is the previous year relevant to you, the indexation will be done at the rate of 289, and for the previous year, that is 1819, it was 280. So how do you do that? You consider the index cost by taking cost into cost inflation index of the year in which asset is transferred divided by the cost inflation index of the year in which the asset was acquired. Okay, that's how you do it. Or beginning of 1/4/2001, whichever is later, which means if you acquired the asset before 1/4/2001, then you can consider the value on 1/4/2001, which means if we are talking about the inflation index, then we will take it as 100, or we will take it as any other value depending on the year in which you acquired the asset. Okay. Then we have third proviso, and third proviso to section 48 says that first and second proviso should not apply wherever we are dealing with section 112A. So this was added the last year. Okay. Nothing contained in first and second proviso shall apply to the capital gains arising from transfer of a long-term capital asset being an equity share or a unit of equity-oriented fund or a unit of business trust, which are referred to in section 112A. Three things: equity shares, unit of equity-oriented fund, or units of business trust. These three will be governed by section 112A, and if they're governed by section 112A, then by default, proviso, first proviso and second proviso shall not apply. I hope this is clear. Okay. Next is fourth proviso to section 48. The second proviso to section 48 not to apply in case of nothing contained in second proviso. That is, again, we are talking about indexation shall apply to the long-term capital gain arising from the transfer of long-term capital asset being a bond or debentures, which means in case of bonds or debentures, you will not get the indexation benefit. However, there are two such bonds in which case you will get the indexation benefit. One is the capital indexed bonds, which are issued by the government, or we have the sovereign gold bonds, which are issued by RBI. Apart from these two category of bonds, for all other bonds, the benefit of indexation will not be given to you. Okay, and that is written over here. The benefit of indexation is not available for bonds or debentures of any company, whether public sector company or any other company. Similarly, the benefit of indexation is not available in respect of bonds issued by government, and only in these two categories, that is capital indexed bonds or sovereign gold bonds, you will get the benefit of indexation. I hope this is making sense. Next is fifth proviso to section 48. Now, fifth proviso again is applicable in case of any SSE who is a non-resident. So see, what happens is, if non-resident is making investment in the rupee denominated bonds, so Indian authorities will issue rupee denominated bonds because they don't want to issue bonds in foreign currency, because they don't want to take the currency exposure, right? Now, if rupee denominated bonds are issued, so it might happen that the US investor is investing in these bonds, and during this, once they want to redeem their bond, at that point of time, they are enjoying some appreciation because of currency fluctuation, which means, you know this, we have done all this in Forex. Okay, so you must not have thought it ever, right, that the SFM and direct tax can also be interlinked to an extent, right? So what it says is, if you remember this, I've told you this, when you're investing in a foreign currency, It becomes an asset for you, and you're afraid of asset going down. Which means if US investor is investing in Indian bonds, they would want Indian bonds to they would want Indian rupee to appreciate. And if rupee appreciates, then because of currency fluctuation, they will make some gains. Now, fifth proviso makes it very clear that if on account of rupee appreciation, in case of rupee denominated bonds, if a non-resident is making any income, then such income will not be taxable under the head capital gains. There will be no taxability for that. That is what is written in fifth proviso. If on the bonds, the rupee denominated bonds, interest is paid to the US investor, then that interest obviously will be taxable. But if investor is getting any benefit because of appreciation of rupee, then it will not attract taxes. But if there is depreciation of rupee, then the US investor will stand to suffer loss on account of such depreciation. And in that case, you will normally abide by the first proviso, because shares or debentures are covered, how the computation is to be done is covered in first proviso. Then first proviso will apply. But wherever any rupee denominated bonds are purchased by a non-resident and he enjoys any capital gains on account of rupee appreciation, then fifth proviso will come in, and there cannot be any taxability on such appreciation. Okay, I hope this is clear. Let's read it. Provided also that in case of an SSE being a non-resident, any gains arising on account of appreciation of rupee against the foreign currency at the time of redemption of rupee denominated bonds of an Indian company, earlier it was subscribed. Can you just strike through subscribed? Just strike through, cancel it in a way that you are able to read it like this. Okay, now what does this mean? This means that earlier the criteria was a little stringent. Only if you are the one who has actually applied to the bonds, then this benefit was given to you. But now whether you have subscribed to the bonds or not, which means it can be a case of purchasing it from some other person and not directly subscribing to the actual issue by the government, by the issuer. I hope you have understood that. It can be a case of subscription. It can be a case of repurchase from another person. Okay, so now the condition is held by him. He should be the holder of the bond, and at the time of redemption, obviously you should be redeeming the bonds with the company. But if you sell the bonds prior to its maturity, you can't get the benefit. Okay, shall be ignored. What shall be ignored? Any appreciation of rupee for the computation of full value of consideration under this section. Okay, who will get this benefit? Non-resident. What benefit is given? Any gain arising on account of appreciation of rupee against foreign currency. If gain arises on redemption of rupee denominated bonds, that is not taxable. The benefit is available even if non-resident has purchased the RDP from the market. As I told you, he is purchasing from some other buyer. Needless to say, the benefit is also available to the original subscriber. But the benefit is available only if the bonds are held till its maturity. That is, they are not transferred before maturity to somebody else. I hope this is clear to you now. Okay, like take one example. Indian company issues rupee denominated bonds to prevent themselves against the risk of exchange fluctuation. If RDB of face value of rupees 1 lakh is issued with coupon rate of 5.75%, then the non-resident need to bring foreign currency equivalent to rupees 1 lakh. When these bonds are redeemed, then Indian company will pay rupees 1 lakh to non-resident, who will then convert this rupee back into dollars. Okay, this is the normal scenario. Now, suppose if RDB of rupees 1 lakh are being purchased by a non-resident and total bonds of 70 lakhs are purchased, which means, and the rate is 70, then non-resident will have to bring an amount equivalent to $1 lakh. I hope this is simple maths, right? 1 lakh into 70 lakhs. Now, on the date of conversion, that is on the date of redemption, the rate is 63. Which means if 70 has become 63, obviously rupee has appreciated, and on converting back this into dollars, the entity will receive more, which is 70 lakhs divided by 63. If you do, you will get 111. And there is a gain of $11,111 on account of rupee appreciation, and this will not be taxable. This will not be taxable. I hope you got this point. But if the bonds, suppose in the above example, are redeemed at a premium of rupees 5,000, which means you're getting rupees 1,05,000 for every bond held by you, then on conversion you will get 116,667. In that case, 3,50,000 is taxable. Why 3,50,000? Because you're getting 5,000 for every 1 lakh of investment. So for 70 lakhs, you will get 5% extra, which is 73,50,000. I hope you got this, because 5,000 on a bond of rupees 1 lakh is 5%, which means on 70 lakhs, you will get 5% total, which is 73,50,000. Out of that, 3,50,000 is your premium on redemption of bonds. That will be taxable, right? And that will be treated as short-term capital gain, because if you see the previous example, the holding period was less than 12 months. Okay. Next. The $11,111 shall not be taxable since it represents gain on account of appreciation of rupee. Okay, that will not be taxable, obviously. Suppose in the above two questions, the rupee depreciated and the date of redemption, on the date of redemption, the rate is 75. If 70 becomes 75, then in that case, there is a rupee depreciation, and then fifth proviso cannot apply, and then obviously you will have to do the computations as per first proviso. That's what I told you. Okay, please try do it, then I'll tell you the final answer. Case 2 is based on the previous question, guys. And in case 2, the total amount received is 73,50,000, including that premium. That will be converted at the rate of 75. Okay. And then the initial investment was 70 lakhs. That will be converted at the rate of 70, which is $1 lakh. So there is a short-term capital loss of $2,000 in this case. Hope this is clear to you. Next is the last proviso, which is 7th proviso to section 48, which says that if there is any STT being paid, you will not get deduction for the same. No deduction shall be allowed in computing income chargeable under the head capital gain in respect of STT paid. STT can be claimed as a expense if you are reporting your trading in shares as PGBP. Then you can get the benefit. Otherwise, STT benefits will not be given to you. Any STT paid will not be allowed as a deduction. Okay, so just go through this, then we will move on to our next section, that is section 55. Please go through this.